The Japanese yen continues to slide and the dollar yen pair has hit a new one-year high today. Hello traders, Fawad Razakzada here, market analyst with City Index. So today's jobs report came out quite mixed, with the headline figure disappointing expectations at 50,000, and there were downward revisions for the previous numbers. But among the positive signs in the employment report was that full-time jobs was more than expected, while the unemployment rate fell to 4.4% against expectations of a drop to 4.5%. So that was the positive aspect of the report. We also heard from the University of Michigan, who released their closely watched consumer sentiment survey, and that came in higher than expected at 54. And as a result of that, we saw the US dollar extend its gains. The dollar yen broke above the 158 handle, hitting a one-year high today, which is quite significant. It has also taken out the November high at 157.90-ish. The next upside target from here, should the bullish momentum continue, is last year's high, which was hit in January at around 158.88. That level is now less than 100 pips away from here, so it could well rise to test that level at the very least, I would imagine. If, however, the breakout fails and we go back below the November high and post a bearish close, a bearish candle here today, that would be significant because it would point to a false breakout scenario. But we will cross that bridge if and when we get there. For the time being, the trend is quite bullish, and the path of least resistance is therefore to the upside. So I wouldn't be surprised if in the coming days the dollar yen were to climb to 160 handle, which is the next big psychologically important level, where we might see intervention from Japanese authorities. It's also worth keeping an eye on other yen crosses, and chief among them the euro yen, which continues to print bullish price action, and this currency pair has recently been consolidating inside what looks to be a bull flag pattern. Today it looks like the bulls are back, and we could potentially see a break above the resistance trend of this pattern. If that happens, then the next upside target will be liquidity resting above the most recent high that was made at 184.92, and above that the 185 handle is the next key level to watch. In terms of support, the area around this level at 183, call it 183, is quite important, given that this area was previously resistance. We broke above it during the rally over here as I zoom in. Then we retested this level, and so far this area has held. We can refine our levels more precisely and put a line above the high of the previous day's candle. Let me just color that in a different shading. 183.25 is the high from the previous day. So that area needs to hold now between these two levels for the bullish trend to remain intact. The line in the sand for me would be the low, would be this low right here, which was the last major low created prior to the latest breakout. So if that low were to break in the coming days, at that point you'll have to drop your bullish bias on this currency pair. For more market updates and insights, head over to City Index. I'll see you in the next video. Take care.